Think about the last time you opened a fresh spreadsheet and felt proud. New side hustle. New motivation. Maybe it's an Etsy shop, weekend photography, consulting, flipping stuff online. You're doing the adult thing. You're tracking expenses, laptop, Canva, shipping labels, a new lens, website hosting, gas. Then the thought hits you mid-receipt screenshot. Wait, if I deduct this, does it change my whole tax situation? Because you've heard two completely different messages. Message 1. Just take the standard deduction. Easy. Message 2. Deduct everything. It'll lower what you owe, so you start spiraling. Do you need receipts for every $12 purchase? If you take the standard deduction, are these side hustle expenses pointless? And why did your friend say they wrote off their mortgage and donations, but TurboTax still picked the standard deduction anyway? This is the exact moment most W-2 side hustlers get trapped. Not because you're bad at taxes, because you haven't run the one comparison that decides whether your extra effort actually changes the number you pay. Here's what most people don't realize. There are two totally different deduction systems happening on the same return, and the tax software doesn't explain the difference in plain English. Your side hustle expenses live on Schedule C. That's the form that figures out your business profit. IRS guidance for small businesses explains that you deduct ordinary and necessary business expenses to get from your gross receipts down to net profit. That net profit is what ends up flowing onto your main return. Separate from that, your personal itemized deductions live on Schedule A. That's the list of personal write-offs like mortgage interest, state and local taxes, and charitable donations. Now here's the trap. You only get to use Schedule A if your total itemized deductions beat the standard deduction, and that standard deduction is big. For tax year 2024, it's $14,600 if you're single, $29,200 if you're married filing jointly, and $21,900 if you're head of household. So that moment you recognized in the beginning, you tracking every expense and wondering if it stacks, here's what was actually happening underneath it. Your Schedule C expenses can reduce your side hustle profit no matter what. But your Schedule A personal write-offs can become basically invisible if they don't exceed the standard deduction. Let me be clear about something. The fix isn't deduct more. It's sorting deductions into the right bucket, then running the standard versus itemized math. And it goes deeper than that. Once you see the two buckets, you stop expecting the wrong things from your side hustle. Schedule C is your side hustle bucket. It's where your business income and business expenses fight each other. Whatever is left is your net profit, and that's the number you actually get taxed on as business income. IRS Small Business Guidance describes deducting ordinary and necessary expenses to arrive at that net profit, and that happens before you even get to the standard versus itemized decision. Schedule A is your personal bucket. Mortgage interest, state and local taxes, charitable giving, medical expenses above certain thresholds. This bucket is optional, and it only helps if the total beats your standard deduction. Take someone like Marcus. You're W-2 at your day job, and you made $8,000 selling photos on weekends. You spent $1,200 on a used camera lens, $240 on editing software, and $300 on a website. Those expenses belong on Schedule C because they're tied to earning that side hustle income. Even if you still take the standard deduction, those Schedule C expenses still reduce your business profit. That can matter twice, because self-employment tax is its own thing. The IRS says the self-employment tax rate is 15.3%. What this means for you: don't stop tracking business expenses just because you take the standard. That's a false choice. Your business bucket works either way. But here's the twist: that doesn't automatically make itemizing worth it. And that's where people waste time, or miss real savings, depending on which bucket they're actually adding to. Now zoom out to the decision that quietly determines whether your personal write-offs count at all. Itemizing means listing personal deductions on Schedule A. Standard deduction means you take a flat amount the IRS gives you based on filing status. You don't get both. So if your Schedule A total doesn't beat the standard deduction, your itemized deductions don't reduce your taxable income, even if they're real expenses. For 2024, that standard deduction is $14,600 single, $29,200 married filing jointly, and $21,900 head of household. Picture a homeowner with a side hustle. You paid $6,500 in mortgage interest, gave $1,200 to charity, and paid $9,000 in state income tax plus $4,000 in property tax. You'd think that's a lot. I must itemize. But the SALT deduction, that's state and local taxes, was capped at $10,000 for years under the Tax Cuts and Jobs Act. So your $13,000 of state plus property taxes gets chopped to $10,000. Now your schedule of math is $6,500 plus $1,200 plus $10,000 equals $17,700. If you're married filing jointly, you're still way under the $29,200 standard deduction. So itemizing doesn't move the needle. What this means for you today, if you're not close to your standard deduction number, chasing personal write-offs can become a paperwork hobby with zero payoff. But if you are close, one category can push you over, and side hustlers miss that category all the time. You've got the two buckets. You've got the threshold test. Now comes the part that actually changes your tax outcome. The moments when a side hustle quietly flips the math in your favor. Because the side hustle doesn't just add income, it changes which thresholds you bump into. Most of the time, the side hustle doesn't magically make itemizing worth it. Your business expenses still live on Schedule C, and they still matter even when you take the standard deduction. That part is stable. What changes is your adjusted gross income, your AGI. And a bunch of itemized deductions only count after you clear a hurdle tied to AGI. Here's a real one: medical expenses. The IRS says you can only deduct the part of unreimbursed medical and dental expenses that's more than 7.5% of your AGI on Schedule A. So take Danielle. W-2 job, plus a small consulting side hustle. You have $12,000 of unreimbursed medical bills in a rough year. If your AGI is $80,000, 7.5% is $6,000. That means only $6,000 of that $12,000 is even eligible to show up as an itemized deduction. Now raise AGI with side hustle profit. Say AGI becomes $90,000. 7.5% is $6,750. Same medical bills. Now only $5,250 is eligible. That's the sneaky part. The side hustle can make some itemized deductions harder to use, even as it makes your bookkeeping feel more worth it. But in lumpy years, you buy a home, you have unusually high giving, you have a medical year, itemizing can flip on. And when it flips on, every legit schedule a dollar suddenly counts. So the move isn't guessing. It's running the comparison every year, and paying extra attention in the years that aren't normal. Here's exactly what to do. Not theory. A quick system you can run every year. Step 1. Do a 15-minute, 2-run test. Write down your likely schedule of totals. Mortgage interest, Form 1098, state plus local taxes. Remember the cap, charitable gifts, and any medical expenses that clear the 7.5% of AGI hurdle. Compare that total to your standard deduction for your filing status. If you're not close, stop hunting for itemizing this year. Step 2. Keep Schedule C clean anyway. One account or one card if you can. Track the big buckets: supplies, software, fees, advertising, mileage, and home office only if you truly qualify. This is the bucket that reduces your side hustle profit regardless of standard versus itemized. Step 3. If you're within striking distance of itemizing, build a proof packet now. Donation acknowledgments, property tax statements, the mortgage interest statement, and a simple running tally. No panic in March. Step 4. Label your calendar: home purchase year, big medical year, unusually high giving year. Those are your likely itemizing years. If you want, drop a comment with your side hustle type and whether you rent or own. That changes which levers matter. And if this was useful, you'll want the next video on the side hustle deductions that still matter even when you take the standard deduction, and the record-keeping setup that makes them easy. Subscribe if you want more of the stuff the software never explains.